Welcome back to the final round. The U.S. economy adding 4.8 million jobs in the month of June, unemployment rate falling to 11.1%. Let's talk more about the market's reaction to these numbers with Solita Marcelli. She's UBS Americas Global Wealth Management Chief Investment Officer. And Solita, great to have you on the show this afternoon. Looking at the jobs report numbers that we got and the action that we're seeing or that we saw in the market today, what do you make of the market's reaction to this? And was this enough? Was this exactly what investors wanted to see?
Good afternoon. Great to be here with you. You know, it's an interesting day. On one hand, you have this very strong employment numbers all around, really strong in terms of participation, unemployment rate declining, and payrolls. On the other hand, all day long, you have headlines around how nationwide we're reaching 50,000 cases. Just in Florida, 10,000 cases. So I think the market is, it's a bit of a tug of war between faster than expected acceleration in recovery in some parts of the economy, and on the other hand, fears of second wave coming in. So I think it's a normal reaction. At the end of the day, you know, there's no doubt these second wave concerns have been rising in the U.S., especially in the Southern Belt states. I believe that this recent surge, while increasing volatility in the near term, will not be derailing the economic recovery. And there are really two main drivers of the market these days. One is the Fed liquidity that's helping expand valuations, and the second wave concerns. Like I said, second wave concerns, short-term volatility, but in the medium term, I think Fed liquidity is going to win. It's going to keep on driving markets and driving them higher.
Well, Solita, going off of that, what do you think is priced into the market at this point? Because you mentioned the fact that we're seeing this fast recovery so far. It's helped support the recent rally that we've seen. But on the flip side, as the number of cases continue to climb, the pace will therefore begin to moderate. So what do you think this means for the market?
I think, first of all, market is pricing in a couple of things. One is that we're going to keep on having Fed stimulus as well as fiscal stimulus that is helping bring back the economic recovery. I think, like I said, it's the biggest driver actually of the market. But also, I think there's a sense that while it might be slow, economic recovery is going to move in the right direction, right? You know, even though we might get delays in reopenings in certain parts of the country and maybe even return to restrictions, we do think that it's going to be quite targeted. These flare-ups also are more localized, and the places that had the worst, that were hit worst couple months ago, are better equipped to deal with a second wave. So I think what's priced in is further recovery, earnings recovery, especially in 2021. I think the market has already looked through the fact that this year is not going to be a great earnings year, maybe close to about 25 to 30% decline overall in earnings, but it's really looking to next year. And also, I think what's priced in is a positive view that a vaccine is likely to come by the first half of 2021. Granted, there is still a lot of risks around it, but a lot of money has been thrown at this. There is a global race to reach a solution in that perspective. So I think when and if the vaccine comes, I think it will unleash the last leg of the rally. But I think partly that it's moving in the right direction is also priced in.
Hey, Solita, Rick Newman here. So a different thing to look at is the 2020 election. Joe Biden now really taking a lead against President Trump in the polls. And some analysts are saying, well, the market has not yet priced in the likelihood of perhaps a Democratic sweep because Joe Biden has different policies, a tax hike, corporate tax hike, for example. However, if the Federal Reserve is basically carrying asset prices at this point, does it even matter? Do you even have to price in possible policy changes such as that?
Well, great question. It's, 4 months is a lifetime in U.S. presidential elections, so too early to make a big call on this. But I do think that, as elections are definitely becoming increasingly more relevant for the markets as we get closer to November. Just a couple of months ago, the current administration's chances of a two-term presidency seemed likely, and because of its light regulatory and low tax policies, markets, didn't seem to care, seemed to be fine. Yet after the pandemic, as you mentioned, as well as the social and racial justice movement took center stage, we saw Biden's chances increasing. The chance of a blue wave gone up significantly, but still, market is not concerned about it just yet.
Yeah.
I think, you're absolutely right. The Fed policy is going to dominate. So when we look at the scenarios that we could end up with, we can think of four. Two of them represents a unified government, blue wave, red sweep. The other two is divided. And in none of these scenarios right now, we're seeing a significant negative impact on the market. I know a number of market participants think a blue wave might be negative for risk assets, but frankly, we think it will be closer to neutral because any impact on earnings from rising corporate taxes, as well as a more stringent regulatory agenda, would be likely to be offset by further fiscal stimulus.
All right. Solita Marcelli, thank you so much for taking the time to be UBS's America's Global Wealth Management CIO there. We hope to have you back. Thank you.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.